So a very good evening to all of you, and good afternoon and good morning to people from other time zones. All right, so let's get started. Let me just set out the agenda for today's webinar. So we're going to talk about the CFA course. I think this is something that has already been indicated to all of you, and I really thank you guys to have taken some time out to be there for the webinar. So the agenda is we're going to talk about the CFA and in particular CFA Level 1. I shall be discussing, who could be the ideal candidate for this exam. So who should be writing this exam? Who should in the first place be registering for the program? What are the kind of career opportunities that await you or awaits you after clearing the exam? This is one thing which all of you would be interested in. And for people who've already registered themselves for the program for CFA Level 1, I think they would be pretty curious about knowing how should they go about preparing. Now, I believe a lot of you would be planning to write your CFA exams in June 2016, and some of you might be looking to write your exams in December 2015, which is like 2 months away. I would be looking at that part as well. So for candidates who just have 2 months and they are about to start or yet to start, and if they are wondering whether they can crack the exam, my answer would be a resounding yes, and I shall indicate how to go about. But not to in any way indicate that that's the right way of going about. The earlier you start, the better it is. So we shall any which ways try and address that issue. I'm going to take a small discussion on one of the basic topics in CFA. I mean, time value of money. Now that's a topic which is part of the quant section, but will find its application in almost every domain that you would go through in the CFA curriculum. So we would be looking at equity, fixed income, uh, valuation of other alternative assets, and you would invariably see that time value of money find its application in almost every area. So I thought this would be a very basic topic, but at the same time a very, very useful topic having a very wide application, and hence I tried to choose this topic for today's discussion. Maybe we would take out 30-35 minutes just to have some basic discussion on this topic. I think this would especially be of interest to people who are absolutely new to this program. And not to forget, the most important part of the webinar, I would be very, very, uh, uh, I would say, anxious to take your questions and answer them. So I would leave the floor open once we are done with the topical discussion. So irrespective of how much we cover of the topic, I think I would just try to keep aside the last 10 minutes, 5 minutes of the webinar for your questions, and I would love to answer them. Okay, great. So just a bit about us, about myself and my colleague. Uh, we are the ones who are going to take you through the course. So I'm Amit Parak, and a quick introduction. Uh, I have dabbled with corporate banking, equity research, strategic finance before really getting into full-time training. So I've spent around 6 to 7 years in the industry before I decided that let me get into training and academia on a full-fledged basis. So what I do, I teach finance, I teach accountancy, cost accounting, mathematics. So these are subjects which are of interest to me, especially finance and mathematics. So I love dealing with numbers, and I teach maths at different levels. Uh, I have been fortunate enough to have written quite a few exams and to have uh, cleared them. And I believe that is where my strength was. I mean, I was pretty good at cracking exams, and hence I thought, let me try and help you guys do the same. So, be it CA, CFA, FRM, which is Financial Risk Management, MBA. I did my MBA from IIM Ahmedabad, Indian Institute of Management. uh, I could possibly be of some help to you guys. So I'm there to help you out. So my colleague Ankur, he's a veteran CFA trainer. He's been training for the last 7 years, and I believe he's one of the best trainers that we have in this country. He's worked in corporate finance area. He was associated with Suzuki, and he has spent a few years in consulting and advisory role, and he was with Ernst& Young. He's been a serial ranker. That's how I describe him, be it the university exams or CAs or be it CFA, where while you don't have ranks, but he was really there in the top percentile. He's a swimming buff and he loves teaching like what I do. So there we are, and now you would get to know more about us as and when we get further into the course, but today it's going to be our session with me. So a little about CFA. So CFA Level 1 in particular, that marks your entry into the program. So you register for the CFA program and then you register yourself for the CFA Level 1 exam. For people who are new to CFA, you would have 3 levels, level 1, 2, 3, and you can write your level 1 in December or June. Level 2 and level 3 exams, they happen in June. So what is CFA all about? Well, you would deal with areas like ethics, quantitative techniques, quants as I call it, FRA, financial reporting analysis, corporate finance, portfolio management, equity, fixed income, derivative, economics, alternative investments, alternative assets as we call it. So there are quite a few areas which you need to master, and the weightage of all these areas would spread somewhere within the range 5 to 15%. So that is where it would be, except I think the exception being FRA, which would nearly have a weightage of 20%, as you can see it in the pie graph, which is there on one corner of the slide. Now, let me tell you, while you have these many areas and we do have the tendency to pick the more important ones, let me tell you, I mean, all areas are important. I mean, you just can't afford to drop any of them as far as your preparation is concerned. So most of these areas, in fact, all these areas would find adequate proportionate representation in the exam. So that means that if I leave out a particular area, let's say if I were to decide and I were to leave out economics because that's quite voluminous, and people like to believe that given that it has a 10% weightage, and you have to read uh, volume as far as this particular subject is concerned, a lot of people tend to go a little easy on economics. I mean, they do part of it, they leave it out. I mean, I'm dead against it. I think every area would have its share of easy questions, difficult questions, and in case if you decide to leave out that area entirely, I think you let go at least the easy questions. So my strong suggestion is take up all the areas, try and make sure that you cover all of them, irrespective of the kind of time that you have. All right. So what is the exam going to be like? So you're going to have, and I'm going to be in specific talking about CFA Level 1 because that's where my focus is right now. And I would assume that all of you there are prospective level 1 students. So level 1 is going to have two papers, AM and PM. So there's going to be a morning session and there's going to be an afternoon session. So there are going to be two papers that you need to write. Both the papers, each paper rather, would consist of 120 questions. So you're going to have 180 minutes, so 3 hours paper. You got to cover 120 questions. So that would practically give you 90 seconds for every question that you attempt on an average. All these questions are going to be MCQs. That means they are going to be multiple choice questions. Every question would be followed by 3 options, and you got to tick one of them which you think is the correct one. So the question is there any negative marking? There is none. Okay, so I would suggest that you should attempt every question irrespective of whether you know it, I mean, whether you think you know it or you don't, right? So you got to attempt every question. There are 120 questions to be covered in 180 minutes each paper. So that gives you 90 seconds for every question. So does it make your task difficult? Yes, but not very, very difficult. Why? Because some of the questions is going to take less than 90 seconds and some of it is going to take more than 90 seconds, right? So we're going to cross subsidize our attempt, and we would, right? So that's how you would go about. So how would your preparation be? Well, at any point of time, you should be going through a couple of areas. So I would never suggest that if you've chosen up, let's say, quants, and you should be spending days and weeks on quants. So at any point of time, you should pick up more than one area, and you should be preparing parallelly, because I think that will give some variety to your preparation and would make it interesting. You should definitely regularly watch and listen to the video tutorials, be regular for your live sessions, and in case you missed out one, make sure that you are able to access the archive and look at the backup. Uh, Along with the tutorials, I would strongly suggest that you should be going through the practice questions. So if today I teach you time value of money, for example, well, the very next day, or let's say the very next hour, you sit with your practice questions on time value of money, and you try and work them out. I mean, that just improves your retention, I would say, significantly. And trust me, you don't have much time left for the exam, so you would never have the time to go back and then catch up with the practice questions. And it's best done when it is being discussed and when it is being heard, right? So kindly keep your active preparation in parallel to our classes. So who should be writing the exam? Well, anyone who would be interested in the investment industry. So if you're looking to join, uh, let's say, banking or investment banking, or you want to get into the research profile, equity research profile, I think this is the course for you. So in terms of eligibility, if you're in the final year of your college, or you've just cleared your college, I think you're well eligible for it. If you have 4 years of professional experience, you are eligible for it, right? So if you happen to fall into one of these categories and you're really, really very, very inclined towards the finance domain, I would say this is one of the best self-study courses that's available, the best self-study course in finance. Okay, so I think are uh, we are now well placed to start off with our discussion, and I'm going to take up time value of money. I'm going to keep it very, very basic, and I would not really want to make this webinar a heavily technical one. So uh, this is something that all of you would be familiar with in some way or the other, formally or otherwise. So a few questions coming in, and so we have a question from Karthik who's asking, do we need to have finance background to take this course? Well, somebody with a finance background will have some kind of an advantage, at least to begin with. But when we teach this course, we assume that we're starting from scratch. So you could be somebody from an arts background, but if you're somebody who is inclined towards finance, who would look to make a career in finance, I think it should not be a hurdle. So I as a trainer I would assume that every candidate is absolutely clueless about these topics, and hence we would start from scratch. I believe that answers your question. Right? Any other question about the program before we get started off with our topic? Uh, okay, so Biju has a question, how good it would be to crack CFA after doing financial modeling. I think it would be wonderful. There's a bit of synergy in it between CFA and financial modeling. A lot of valuation that we do, which would be taught in CFA, finally it gets it practically gets done by way of financial models. So I think there will be quite a bit of synergy that you will realize, Biju, when you would be going through the CFA course, and you would definitely find it interesting. Having said that, financial modeling is more of a practical course. It's more I would say skill oriented than anything else, and the kind of concept that is needed to have a good grip over financial modeling, I think CFA comes in there. Or for that matter, any finance course would come in there. All right. Well, Parmeshwari has a question. So CA plus CFA, is it beneficial? Well, I can only say, Parmeshwari, that I'm a chartered accountant and I went ahead and did my CFA, and I found it immensely useful. So I believe that answers your question. Rajat finds CFA, rather CA, a tough going, and I think the implied question is CFA going to be the same? Well, in my personal opinion, I think CFA is it's far more conceptual. So rather than rigorous training, if you have a good conceptual grip over the subject, you would be able to do it, right? So I don't think it's going to be as difficult as CA. I mean, that's my opinion. I think it would. It would, Lakshmi. So would your other courses permit you to go for CFA? Yes, it would. Yes, Hitesh. Okay, Hitesh is doing his CMT, so which is basically a technical analysis course. And would CFA and CMT together be beneficial? While I mean, these two are different sciences. CFA tends to focus more on fundamental analysis, while CMT is essentially a very, very focused course on technical analysis. Given that both are related to capital markets, to that extent, yes. Okay, in terms of preparation, I don't know whether I've covered it. Maybe going forward I would. In terms of preparation, how many hours should you be putting in for level 1? I mean, I would be conservative and I would say 350 to 400 hours should be good enough, right? So the institute places it somewhat lower, but I think 350 to 400 hours would be great. All right. Okay, great. I'm open to other questions, but if you guys can just keep it reserved for the end. Right? So Prita, we are going to come up with more questions and answers maybe at the end. So maybe you guys can come up with your questions at the end. So we'll keep aside 10 minutes for that. Thank you guys. So there we go. So let's look at the topic which we are going to cover, time value of money. Now this is the first topic that you would see in quantitative technique as far as your CFA Level 1 curriculum is concerned. And so I'm going to take up concepts related to time value of money, and in particular I'm going to cover things like interest rates, future value, present value. So hopefully I think we should be able to touch upon all of these. So there we go. So let me discuss a bit about time value of money, give you a slow introduction to it. So there I have. So let's say if I were to give you a choice between $100 today, so let's call it, I give you an offer of $100 today, or let's say $100 a year later. So let's call it a year later. All right. So, and if I were to offer you that you can very well take $100 from me today, or you could take it a year later, what would you prefer? Now you would say, well, that's a no-brainer. I'm going to go for this. $100 today is preferable to $100 a year later, isn't it? All of you would say, yes, sir. Then why should it be so? Now you'd say, well, that's very easy. If I have $100 today, I can very well invest it for the next 1 year. So if I get $100 today, I'm going to invest it for a year. For 1 year, I'm going to invest it, let's say at 6%. So at 6%, I'm going to invest it. And this would finally give me $106. All right. And $106 a year later, any day is greater than $100 a year later. So that's absolutely correct, Rajat. So $100 today is much more valuable than $100 a year later. All right, because you have the choice of investing it for the next 1 year, and that would finally give you $106. So let's look at it a little differently. If I were to give you a choice between $100 today or $100 a year later, well, you might not be an, an, an investment guy. You might not be somebody who looks to invest, but you might look at spending this $100. Now you'd say, so if you were to give me $100 today, I can very well buy a nice jacket for myself. Now you have the festive season coming around, and again it's going to be winter in this part of the country, at least in our country, and hence one would say $100 will fetch me a nice jacket, and I can very well enjoy my winter in the warm jacket. So if I were to get it a year later, that would mean deferring my consumption. So I'm letting go my consumption. All right. So what am I alluding to? What I'm trying to say is when I get $100 today, there is an investment utility in it, which gets captured by this extra $6 that I get over the next 1 year. Or if I were to get $100 today and if I were not to invest it, I can still consume it. I can still consume it and enjoy myself. And when I let go $100 today to get $100 a year later, there's an element of sacrifice. I let go today's consumption to go for, let's say, future consumption. So there's an element of sacrifice, and again, there is an investment utility which comes out of getting the money today. So you would say, well, the amount today is much more valuable than the same amount a year later. So can I argue that $100 today is equal to $106 a year later? All right. So you would say $100 today is equal to $106 a year later. In other words, if I were to be given a choice between $100 today and, or rather, $106 a year later, I would be almost indifferent between the two. I mean, you would come back saying, hey, Amit, I mean, I would be indifferent between the two. You can give me $100 today, or you can give me $106 a year later. That's absolutely fine. So the future value of $100, the future value of $100, so this is in dollars, is equal to $106. So how did we get that? Well, we would say, well, we took the present cash flow and we multiplied it with 1 plus the interest rate. What was the interest rate? It was 6%. 1 plus 0.06. Please keep it in mind, 6% is equal to 0.06. So that gives you $106. So here we were able to find out the future value of $100 by multiplying it with 1 plus the interest rate, isn't it? So by the same concept, by the same logic, may I say, if I have $106 a year later, wouldn't the present value of it be $100? Wouldn't the present value of it $100? And how do we get it? How do we get $100 from $106? So if I need to find out the present value, so let me use this part of the screen. So if I need to find out the present value of the future cash flow, well, in that case, I'm going to take $106 and I'm going to divide it by 1.06, isn't it? That's absolutely correct, Rajat. So 106 divided by 1.06, and that gives me 100. All right. So for me to find out the present value of the future cash flow, I divide it by 1 plus R. For me to arrive at the future value of the present cash flow, I multiply it with 1 plus R. All right. I hope this is clear with everyone. So let me try and formalize it. So I'm going to erase this. So I hope this part is registered with everyone. So let me erase this, or yeah. So may I say that the future value of the present cash flow is going to be equal to the present cash flow into 1 plus R, and the present value of the future cash flow is going to be the future cash flow divided by 1 plus R. All right. So we add $100. If we were to transport it 1 year later, it becomes 106. How do we get 106? We multiplied it with 1.06. And from 106, that means the future cash flow, if I need to come to the present value, I would divide it by 1.06. So this is division by 1.06. Okay. So when I multiply it, I call it the process of compounding. Please remember, when you multiply it with 1 plus R to get the future value of the present cash flow, this is known as compounding. And when you move from future cash flow to back to get its present value, that means you're moving back in terms of time from year 1 to you're moving today, year 0, you divide it by 1 plus R, and this is termed as discounting. All right. So to get the future value, I compound. To get the present value, I discount. Isn't it? All right. Yes, yes, that's absolutely correct. Great, great. So let's now move on. So let me now move on to the next slide. So let's see if I can just move on to the next slide. So let's now try and understand what interest rate is. I mean, we've already discussed it a bit. Now, we did see that we used interest rate to find out the future value or to find out the present value. Well, so in one way, interest rates could be used as the discount rate. So that's one way of looking at interest rates. Okay. Now, also try and understand that when I started off my discussion, I started it off saying that that if I were to get let's say instead of the current $100, if I were to get a future cash flow, I should be getting $106. And how did we get $106? Well, by taking into account the 6% interest rate. So may I understand interest rate as the minimum rate of return that I would want on my investment, right? To replace the present cash flow with the future cash flow. So I can let go the present cash flow if I can earn a return of 6%. So 6% is the minimum rate of return that I would want on my investment. An investment basically replaces the present cash flow with the future cash flow. I can also understand interest rate as the opportunity cost of spending. Go back to my discussion when I said, hey, when I go for $106 a year later, I'm letting go the current cash flow of $100. I am letting go my current consumption. So there is an element of sacrifice. I want to get compensated for that. And hence, interest rate can be understood, can be implied as the opportunity cost of spending. So when I spend, I let go a 6% return. So that's the opportunity cost of spending, and that 6% is nothing but the interest rate. Okay, so let me very quickly sum it up. Interest rate could be understood as the minimum rate of return that I would want on my investment. It could be understood as the opportunity cost of spending. That means the return that you forego when you decide to spend instead of investing. Or it could very well be understood, simply be understood as the discount rate or the compound rate, which is used to find out the future or present value of the future cash flow or the future value of the present cash flow. So that's how we would interpret interest rate as. Moving on, let's now look at what interest rate would consist of. Now, in my example, I had taken the interest rate to be 6%. So, okay. So I had used 6% as the interest rate. So in our example, we had taken the interest rate as 6%. So let's now try and analyze how does this figure of 6% conjure up? What is it built of? What are the components that go into 6%? Now you would say that Amit, when I try to invest $100 today, I'm letting go the current consumption. So there is quite a bit of sacrifice that goes into letting go current consumption for future consumption, right? So there's an element of sacrifice. You want to get compensated for that. So you would argue that since I am sacrificing, so there's an element of sacrifice, you let go the current consumption, you want to get compensated for that, and you say, okay, you need to give me 3% extra. So if I invest $100, you need to give me 3% because I'm letting go the current consumption. I'm letting go this money. So you need to give me 3%. I would not buy the jacket today. I'm going to buy it next winter. But then, letting go the current consumption involves sacrifice. So 3% is the amount of compensation that I would want for the sacrifice. So that is what you demand as an investor. Now, you also remind me of the fact that when you would be purchasing the jacket a year later, the jacket is in all probability going to cost you more. So this jacket could have easily been bought for $100 today, but maybe a year later it's going to cost you $102. That means there could be a 2% rise in price levels, and you would want to make sure that you get that extra $2 when you invest $100. So you would say, hey, I think I would be happy enough if you could give me another 2%, because that's the inflation which is expected to prevail over the next 1 year. And so I would be happy enough to get, let's say, 5% return, at least 3% on account of the sacrifice that I make, so that compensates me for that. 2% as the compensation towards the possible price rise. So all in all, I would seek a return of 5%. I would say, great, okay, I'm willing to give you 5%. Now this 3% is technically termed as the real risk-free rate, guys. So let's call it RF, or the real risk-free rate. Okay, so kindly keep this in mind, that this is the real risk-free rate. This 2% is your inflation, all right? And your real risk-free rate plus inflation would become the nominal risk-free rate, and which is normally alluded to as the risk-free rates. So moment they would say 3%, they would qualify it as the real risk-free rate. So the real risk-free rate plus inflation becomes the nominal risk-free rate. So normally when you hear interest rates, yields, returns, those are all nominal rates. The inflation component has already been factored in. Unless and until they qualify an interest rate as real, always assume that inflation is already built in. Okay? Now, so I was almost quite happy with giving you a 5% return. So you are lending me money. I'm quite happy to give you a 5% return. But then you remind me that, hey, I would need another extra 1%. And I would say, what for? Now you would say, well, Amit, I've just been knowing you for a while. It's just been a couple of days, and there's a possibility, excuse me. So there is a possibility that that you might default. Or let's say when I lend out to 100 individuals, there could always be a few individuals who could, who would likely, who would likely, possibly, who would default. So there's a risk in investing, there's a risk in lending. So if unless until I try to build in that expected loss into my return, I would end up having less than what I had invested. So fair enough. So you would seek a 1% risk premium. Okay. So that's a risk premium that you're going to seek. So all in all, you would be seeking a return of, so nominal risk-free rate plus the risk premium. And you would say, okay, great. You give me 6%. Okay, so you would say, hey, I would be happy enough to get a 6% return, and this 6% return is known as the risk-adjusted return. Please keep it in mind. 5% is the risk-free return. 5% plus 1%, which is your risk premium, makes it 6%, which is the risk-adjusted return. So the 6% in our example possibly consisted of these three elements: real risk-free, inflation, and default risk premium. There could, of course, be other investments which would try and build in liquidity premium and maturity premium. Let me just spend a few seconds on this. Of course, I think you will become these things would become much more easy for you to comprehend as we move further deeper into the curriculum, especially when we would start looking at fixed income. So liquidity premium essentially is the extra return that you would seek from illiquid assets, right? So you invest into certain assets, you buy certain assets, but then you feel that as and when you would look to sell these assets, it would not be easy to sell them. You might not be able to realize the fair value of it. So there could be some amount of hit that you might have to take. And hence, to begin with, you would try to seek a higher return from these assets. So you would try to build that into the price of the asset. You would, in other words, say, hey, I'm going to pay a lower price for this asset, right? In other words, you would seek a higher return from those assets. Maturity premium, I mean, in simple words, if I were to put it at this point of time, longer investment horizon. So there is a 10-year investment, there is a 1-year investment. You would try to seek a higher return from a 10-year investment simply because there is much greater uncertainty associated with a longer term investment, isn't it? It's very, very difficult to predict future. So farther the future, the more difficult it becomes to predict it. There is greater amount of unpredictability, and hence you would seek a higher return. So if you were to lend out money to somebody for 10 years, most likely you would seek you would charge a higher interest rate vis-a-vis, let's say, when you are lending out to somebody for a year. And so you might be lending out to me for a year at 6% per annum. So if I say, hey, I want it for 10 years, you might say, okay, give me 7% per annum. All right. So that extra 1% is on account of the maturity premium. I hope this is clear with everyone. So are we well poised to move to the next slide? Any question? So let me try and erase this portion before we move on to the next slide. Okay, great. So there we have it, the future value of a single cash flow. So let's very quickly do this. You have $800 in your pocket, and interest rates are 10%. what would be the future value of your money in 1 year, in 3 years, and in 5 years? So let's see. So I have $800, all right, and I would want to know what shall be the future value of it 1 year later. So we are today over here. So today would generally be termed as Y0. Okay, so get conversant with these notations. So Y0 means today at this point of time. So if I were to look at the future value of this $800 a year later, you would say, hey, that's easy. We just did it. It will be 800 into 1 plus the interest rate. I'm going to use R for interest rate instead of I so that there is no confusion. So this would be 800 into 1.1 because R is your 10%. So that's 0.01, 0.1. So that makes it $880. So that is what it is going to be 1 year down the line. Absolutely correct. And 2 years down the line, we would want to know it. We would want to know the future value in 3 years time. So let's say 3 years time, you will have three compounding cycles, isn't it? So 800 into 1.1. This will get further reinvested at 10% and hence would become 800 into 1.1 square. And this would get further reinvested to finally give you 800 into 1.1 cube. So I'm not calculating it. I think this is something that you guys would be able to do it easily. So let me just show you the working. So this is how the expression would look like. So $800 into 1.1 cube. So 3 when I'm investing it for 3 years. So similarly, when I invest it for 5 years, it's going to be 800 into 1.1 raised to the power 5. All right. Yes, I would believe that the answers that are coming in should be absolutely correct. So this would be $880. So I would not know the maths of this. So 800 into 1.1 cube, well, you can very well work it out. It should be 800 into 1.331. So I mean, this is something that you would be able to work it out. And 800 into 1.1 to the power 5. All right. So let's now move on to the next question if we have one. So let's see. So let me erase this. All right. So there we have it. Calculate the future value of $800 at the end of 10 years if the annual interest rate is 4%. Yeah. So what should that be? So $800 is what I've invested today. So what is going to be the future value of it 10 years down the line? So we are over here, Y0, and then you have Y10. What shall be the future value of it? Well, it's going to be 800 into 1 plus R, which is 1 plus 0.04. 4% is the interest rate. This is 4 raised to the power 10. All right, so it's going to be 800 into 1.04 raised to the power 10. Now I'm getting a few consistent answers, 1184.19. So I believe that should be the correct answer. All right. Okay. Great. Great. Okay. Wonderful. Okay, let me now move on to the next one. So I shall leave the calculation aside. I'm sure all of you would be comfortable with that. So we'll just try and look at how do we go about working it out. Okay, right. So calculate the future value after 20 years of an investment, $1,000, which will be made after 5 years. The expected annual rate of return is 8%. So let's see this. Let me just try and draw the timeline. Now, this is one practice I think which you guys should get used to. I mean, I found it very, very useful. So here we are, Y0, and then you are going to make the investment after 5 years. So after 5 years is when you are going to make an investment of $1,000. All right. And I am curious to know the future value of it 20 years from now. Okay, so this is where I would want to find out what is going to be the future value of it. All right, so how do we do it? Now you would say between Y5 and Y20, you have 15 years going. All right, so this is 15 years. So I have 15 years, so my money is going to be parked for 15 years. So there will be 15 compounding cycle which my $1,000 would undergo. So finally, the future value will be $1,000 into 1 plus r, which is 1.08, 1 plus 0.08, raised to the power 15. I hope this is clear with everyone. So 1000 into 1.08 raised to the power 15. All right. So what do we get? So Rajat says it should be 3172.169. Would others agree with that? So 1000 into 1.08 raised to the power 15. Samuel has a question, which calculator should we be using? I think you can use the TI calculator, the Texas Instrument BA2 professional version. I think that should be a pretty useful calculator. So there are two calculators which are suggested by the institute. Texas Instrument BA2 is one of them. All right. Okay, great. All right, so let me now move on to the next one. Before I do that, let me just erase this. So given a discount rate of 8%, what is the present value of 1500 cash flows that will be received in 6 years? So let's draw the timeline. This is Y0, and at Y6, I'm going to receive $1,500. So what is going to be the present value of it? What shall be the present value of it? Now remember, I get the present value of the future cash flow by discounting the future cash flow, isn't it? So it's a future cash flow divided by 1 plus r to the power n, where n is the number of periods. So going by that, it should be $1,500 divided by, your interest rate is 8%, so 1.08 to the power 6. I shall discount it to the extent of 6 periods because there will be 6 discounting cycles. I hope this is clear with everyone. All right. Okay. So 1500 divided by 1.08 to the power 6. So what do we get? So Rhythm says it's going to be 945. Would others agree? Yeah, Vikas, Hitesh gets 943.39. Others are getting 945. So I think Hitesh, you just need to check. Okay, great. Okay, but this is how you would work it out. Wonderful. Okay, so there we go to the next one. Okay, now we have a new topic within time value of money, and this is ordinary annuity. So let's understand what is annuity. I think I'm just going to discuss annuity and then try and close it there, and just make sure that we have time enough to take questions. I'm sure we would any which ways have this topic in a full-fledged manner as and when we formally start off our course. Okay, I hope you would appreciate that, and thanks for being there. I know it's quite late for some of you. Thanks for being there. So let's understand what is annuity. Now, so far we've been dealing with single cash flows, right? So in most of the questions that we've done, either we ended up finding out the present value of a single future cash flow, or we found out the future value of a single current cash flow. What if I have a series of cash flows? So let me take an example. I worked for a year at a particular place and I was getting a salary of 50,000. So I was getting 50,000 every month. Now this is an annuity. I was getting 50,000 every month at the end of the month. Now this is annuity. Okay, how many such cash flows did I get? Well, there were 12 such cash flows. There were 12 such cash flows. All of them were 50,000 each. Okay, this kind of a cash flow would be termed as annuity. So how would we define an annuity, or how would we understand annuity as? Now, an annuity, or rather an ordinary annuity, would be your equal, periodic, finite number of cash flows. Okay, so these are the three key words: equal, periodic, and finite. So I'm going to receive equal cash flows. So they are going to be even cash flows, and it's going to be periodic. They are spaced apart at equal intervals, and they are going to be finite in number. So you have 12 cash flows altogether. So this is a classic annuity. Okay. Now, in lot many examples that we discuss in finance, well, our cash flows are going to be in the nature of annuity. So we're going to have the same set of cash flows, equal cash flows, but it's going to be multiple cash flows. All right. So that's what would be termed as an annuity. Okay, so how would we arrive at the present value of a series of such cash flows? And so I'm going to take a couple of examples, one where we'll try to find out the present value of annuity, another where we would look to find out the future value of the annuity. So let me take that. Okay. So how would we arrive at the future value of an ordinary annuity? Now, before I get started off with this question, let me take a simple example. So I'm going to receive 50,000 at the end of year one. So let's call it year one. So here I am year zero. Okay. So then I have year two, and then I have year three. So I'm going to receive 50,000 at the end of year one, 50,000 at the end of year two, 50,000 at the end of year three. Now, I'm interested in knowing the future value of these cash flows. So I invest 50,000 at the end of year one, 50 at the end of year two, 50 at the end of year three. What's going to be the future value of all these three cash flows? And when I say future value, I'm interested in knowing what shall be the cumulative value of these deposits which I'm making on a yearly basis. So it's more like a recurring deposit. And let's say the interest rate is 10%. All right. So you would argue that 50,000 which you have invested at year one, you park it for 2 years. This investment is allowed to grow for the next 2 years, isn't it? From Y1 to Y2, from Y2 to Y3. So you would say this 50 would become 50 into 1 plus R square. So I'm just focusing on this single cash flow. So this would become 50 into 1.1 square. This 50 would become 50 into 1.1 because this is invested for just 1 year. And this 50 would remain as it is. So you would say, hey, the cumulative cash flow, or rather the cumulative future value of these series of cash flows is going to be 50 plus 50 into 1.1 plus 50 into 1.1 square. All right. Now, I'm of course not going to go and do this by looking at every single cash flow and then would look to find out the future value of it. We would try and do it cumulatively in one single go by one single expression. So I'm going to take a couple of approaches, one by way of an expression and the other for some of you who have the calculator and who would be interested in knowing how to use the calculator to arrive at the future value. I'm going to just give you some sense of how to use the TI calculator to arrive at the future value. So, but conceptually, how do we go about? So we would say, hey, the future value of annuity, and I'm not going to go into the derivation of this expression, that's for some other day. So the future value of the annuity is going to be the annuity cash flow, which you get every year, divided by R, which I use to describe interest rate, into 1 plus R to the power n, where n is the number of such deposits that you're making, minus 1. All right, so this would give me the future value of the annuity. So let me substitute. So A is 50,000. So this is 50,000. So let's say 50,000. Interest rate is 10%. So that's going to be 0.10 into 1 plus interest rate. So that's 1 plus 0.1. So that becomes 1.1 raised to the power n. You have n such payments. So it's going to be it's going to become raised to the power 3 minus 1. So that would give you the answer. That would give you the answer to this particular question, to this particular illustration that we discussed. All right. So I hope this is clear with everyone. So let's very quickly go to this example and see what would my expression look like. Okay. So in this case, we have 8 years of 8 such payments being made or being received at the end of each of the first 8 years. Assuming the interest rate is 6%, what is the future value after 10 years? Okay, so let's do this. And I think I would end my discussion on time value at least with this question, and then I would leave the floor open to Q&A. So let's very quickly do this. So let me erase this. All right. So we know that the future value is given by annuity divided by R into 1 plus R to the power n minus 1. So let's use this. Here I have a timeline where I'm making deposit, or rather I'm receiving money every year. for the next 8 years. So it's y1, y2, and so on till I come to y8. Okay, so I'm going to get 2000 every year for the next 8 years. All right, and I would want to know what shall be the future value of it after 10 years. So this is where I would want to know what is the future value. How do we do it? Now you would say, let's first get the future value of this at this point of time, because this expression helps you arrive at the future value at y8. So we would say the future value at year 8 is going to be 2000 divided by r, which is the interest rate, which in this case is 0.06, 1.06 to the power 8, because there are 8 such payments, minus 1. All right, so this gives me the future value at year 8. Now, how do I arrive at the future value at year 10? Now, whatever value that you get, so let's say if this is FV8 and you arrive at it, now that's the value at Y8. For me to arrive at Y10, all that I need to remind myself is that this amount will get reinvested for another 2 years. So it will allow, one would allow this amount to grow for another 2 years. So there will be another 2 compounding cycles. So very quickly, if I were to replace it with future value at period 10, well, that's going to be multiplying it with 1.06 to the power 2, because I'm going to compound it further for another 2 years. So that's how I would arrive at the future value. So finally, your answer should be this: 2000 divided by 0.06 into 1.06 to the power 8 minus 1 into 1.06 square. So that gives me the future value of it at year 10. Now, this is how you would do it if I were to do it, well, by way of a simple calculator. Well, if I have a financial calculator, a TI, Texas Instruments, so this is how I would do it. I would say, well, now you're going to have, for people who have it, great, they can use the calculator. For others who don't have it, I mean, I would just simply try and introduce certain tabs now. Within the financial calculator, you will have a tab called PMT. Okay, so there's going to be a button called PMT, which stands for what's a regular payment or the regular receipt that you are getting. So in payment, you're going to feed in 2000. In the number of such payments, which will show up as a tab N. Okay, so there's another button called N. You would say 8. Well, there is no PV, so you would feed in 0 as far as PV is concerned. And then I by Y stands for the interest rate, and that is 6%. So you shall feed in 6. And then you would say compute. There is a tab called compute. Compute FV, and it will give you this face value. This will give you 2000 by 0.06 into 1.06 to the power 8 minus 1. That's the future value that will be thrown up by the calculator. That means the future value at year 8. Don't forget to multiply it with 1.06 square to get the future value at year 10. All right, so that's how you would arrive at it. Now, don't be too surprised or don't get baffled if you get the future value negative, because that's the calculator's way of understanding that if the PMT is 2000, that means if I'm getting 2000 every year, all right, so this is an inflow. So what is exactly, if I'm getting 2000 every year for the next 8 years, what is it that I would have to give back at year 10? Well, that amount would be thrown up by the calculator. Okay, the calculator would understand inflows as cash flows with one kind of sign and outflows as cash flows with another sign. So I would suggest when you work out your problems, you should take inflows as positive cash flows and you should feed them as positive numbers. If you have a problem dealing with cash outflows, you should simply take them as negative numbers when you feed them into the calculator. Okay, if you don't do so, well, sometimes the calculator is going to throw up an error, especially when you try and arrive at IRR, internal rate of return, without really paying attention to the sign of cash flows. You're most likely to get an error term. All right, okay. So I think I would stop here, and I shall leave the floor open to questions. And let me very quickly go to the last set of slides, I think, where I have, okay, let me erase this. All right, so I would skip this for some other day. Okay, so there we go. So what are the advantages of clearing the exam? Now, in case if some of you are contemplating whether to write in December or would you want to write it in June, for people who registered themselves for December, I think you should just go for it. For the simple reasons that if you crack your CFA Level 1 in December, you are or you're well poised to write your Level 2 in June. And then so June 2016 level 2, June 2017 level 3, so you save almost a year. So I think that's a lot of time. All right, in case if you've decided to go for this course, I would say congratulations. It's a gold standard course, acknowledged worldwide. I mean, you go anywhere in East, Singapore, China, Japan, or let's say Middle East, Europe, or the USA, I think CFA is acknowledged all in all countries in the finance industry. So I would suggest that in case if you're working, of course, this being a self-study course just gives you an opportunity to pursue the professional course, and you don't really need to give up your work. So for somebody who is into some kind of an industry, would look to switch over to finance or is genuinely interested towards finance, not that you need to quit your work, you can very well pursue it while working. All right. So I think some of you would have kind of made up your mind. Some of you would still be thinking about it. In case if you are there on board, I would say congratulations, join the club. There you have a great journey ahead. All right. So all right. Okay, great. So let me just take up a few questions. So, okay. All right. Okay, so we have a question from Karthik. Who's asking, apart from class recording, do we have extra video tutorials for all chapters and modules? Yes, there would be, Karthik. Kindly keep it in mind that I'm talking from the perspective of December exam. So our course would be launching from I think from 7 days or a week from now. So we would basically have 2 months or rather 8 weeks. So some of the topics would be provided by way of video tutorials, and topics which are a little more technical in nature, which would require a bit of explanation, we would be looking to cover it by way of live sessions. All right. So for example, a bit of ethics, a lot of economics would be provided by way of recorded tutorials, but derivatives, fixed income, quants, I mean, I would look at taking it live. Okay. Yeah. Rajat is asking, what's the scope in India? I think it's expanding, Rajat. If you would have asked me this question 10 years back, not many people knew about CFA, but today I think the industry, even in India, is beginning to notice this particular course. So especially in the KPOs, in the high-end KPOs, I think CFA, makes it very easy for you to make an entry. So a lot of my students are there in investment banks. So okay, all right. So let me just expand the question window so that I can just have a good look. All right. So FRM or CFA is what Parmeshwari is asking. Well, that depends on Parmeshwari what you're looking for. So if you are somebody who is still naive in finance and you're looking at a general finance course, then I think CFA is a better bet. FRM is a little more specialized. So I think FRM is for people who have a bit of background in finance. Okay, for wealth management, any day CFA. For wealth management, any day CFA, Parmeshwari. Biju is asking, CFA is considered core for corporate finance even in India. Well, corporate finance in India, they look at CAs, CFA, MBA finance almost from the same lens. But I think being a CA as well as a CFA just gives you an advantage. If you don't have a CA, CFA almost becomes essential for you to make an entry into corporate finance. Not much of a difference, Prita. I think merchant banking is almost like a passe. Now you use the term investment banking more often than merchant banking. Level 1 candidates, they could get jobs, but not, I would not say really high salary fetching ones. But yes, in terms of experience, yes, Hitesh, level 1 candidates do get jobs. And it always makes sense to take up some kind of a job because I think that just makes your profile stronger. Yes, Parmeshwari, it is, but I think a CFA is, if I may say so, is a much more respectable course. CFP is great. I think it's specially cut out for wealth management, financial planning. CFA is, it looks at financial planning, but at the same time, it looks at asset valuation. So to that extent, it's a little more broader in scope. Okay, and CFA is an international degree, so I think it just gives you greater geographical mobility. Harsh is asking, should we have any work experience before clearing CFA? Not necessarily. If I can understand your question correctly, Hirsch, if you're saying CFA level 1, well, you don't really need any work experience. For level 2, level 3, do you really need any work experience in terms of clearing the exam? No, not really. But I think it helps in terms of improving your job prospects. I always suggest my student that after level 1, you should just look out for some kind of a relevant experience, and after level 2, look out for something a little more serious, because I think just increases your value, your marketability once you've cleared your level 3. I would be a little scary of situation where you have a fresher who's done his level 1, 2, 3, and is still a fresher. Okay, then the context is slightly different, Harsh. Being a CA final student, you have articleship with you. So to that extent, I think a CA and a CFA combination would do well. It would be Hitesh. Hitesh is, interested in being a value investor trader. Well, value investor and trader, these are two different things. Value investor, definitely, I think CFA would help. For a trader, well, you need to make up your mind. CFA definitely gives you so let me just see in case if we have any question. Okay. Uh, I think the other questions you guys can. I would just try and see if I could. Okay. I think I have kind of answered most of it. Harsh, all these classes would be done online. So I think, being in Hyderabad or Mumbai or anywhere for that matter in India or outside India, you're well placed to take our sessions, because these sessions are going to be online, these are going to be live, and of course, you would have the content coming from Wiley. So I and Ankur would be taking you through the course, and you would of course have the Wiley content with you, and all of it would be provided to you online. Okay, so I hope you guys can also try and visit our website. So Edureka, Edureka. So in case if you've got the link, it's wonderful. So Edureka, and of course you would have the CFA level 1 page over there. So I would insist that all of you should try and visit our web page and act upon it in case if you're interested. Well, Nikita, it's never too late. So Nikita is asking, would 8 weeks be enough for preparation and mocks? I would say, well, yes. Well, it's never too late. A day has 24 hours, Nikita, and we just need 300 hours from you. And there we are. Okay. So I'll just very quickly, guys, go to the, just try and show you. Uh, so there we have it. So while the page gets uploaded, all right. So there we have it. So I hope all of you are able to see the page. So, okay. Thanks, guys. Thanks for being there. I know it's pretty late for some of you. And see you. Hope to see all of you. Thanks. Thanks, guys. Good night.